What's going on, everyone? Welcome to another episode of The Remote Real Estate Investor. Today with me, I have Jason Bott, who's actually a personal friend and my personal broker for a lot of my Midwest portfolio. Jason's going to be talking to us today about all the things that we need to be aware of as landlords and as investors when it comes to insurance. So let's get into it. Jason Bott, man, what's going on? Happy to have you here and thanks for taking the time.
Thanks, Michael. It's always great to talk with you.
No, it's always a pleasure. So I, of course, know who you are, and we'll get into that in just a minute, but I'm curious if you can give everyone a little bit of background on who you are, where you come from, and what it is that you're doing with real estate.
Sure. So my name is Jason Bott. I'm based in Milwaukee, Wisconsin, and I'm a commercial insurance broker. And I've been specializing in the space for about 6 or 7 years exclusively. And so I currently write about 25,000 units in about 30 states. So in any state that you can find reasonably priced real estate that cash flows, that's usually where some of my clients are.
Okay.
And I've been part of the firm. I'm a shareholder at Robertson Ryan Associates. We're a top 100 insurance agency in the U.S. And I've been doing this for about 20 years now. Right
on. And so in full disclosure for everyone listening, Jason is actually my insurance agent. We got connected, I think 3 or 4 years ago now.
I think it's about 4 now.
Yeah. And Jason's been handling the vast majority of my Midwest portfolio, and I've been a very satisfied customer. So thank you, Jason.
Hey, thank you, Michael. We always appreciate the business.
No, absolutely. So for those of our listeners that are brand new to insurance, maybe looking to purchase their first rental or are now taking a look at their insurance, what are some high-level terms that people need to be aware of so they can talk intelligently with insurance brokers or agents?
Sure. So I would say that the main thing that everybody comes up with is, should I do actual cash value or replacement cost?
Okay.
And I mean, that's probably the most universal question of them all. And it's very difficult sometimes to get replacement costs if you're buying not in this market, but let's say 3 or 4 years ago, you could pick up a house for 20 grand, 30 grand.
Yeah.
And it was really difficult to get replacement costs at that low of a level.
Okay.
So, you're going to want to so when you're starting off, the lender will have certain requirements that may hinder you from making any decisions.
Okay.
They may already tell you, hey, you're going to need replacement cost, you're going to need ACV, or you're allowed to have ACV. So I would always say check with your lender first. Anytime we start working with an investor and they say, hey, I'm going to close on this property, we say, that's great. Connect us with your lender so we can get your lender's terms. And then once we have those, we can kind of show the investor what kind of options they'll have.
Okay.
So the best way to maybe compare actual cash value and replacement costs is when you're thinking about replacing a roof. Let's say you have a $10,000 roof on a single family and it's a 30-year shingle and the property is 100 years old. And let's say the roof's 15 years old.
Okay.
Right? On a replacement cost policy, if the hail comes through and sheds it and it blows off, whatever the case may be, replacement cost policy is just going to replace it.
Okay.
It doesn't really matter the cost. So if it's 8 grand, 10 grand, 12, 15, the insurance carrier is going to replace it. On the actual cash value, they're going to say, hey, this roof brand new is probably 10 grand. You're 50% through the 30-year lifespan, so we're going to give you 5 grand. And so now that equation applies to every single thing in your house: the door, the paint, the drywall, the flooring, the kitchen. So those things really do, if you don't have an updated building, it can really harm you. So, if you're talking about buying from a turnkey, operation, like yourselves, where things are maybe fixed up, then actual cash value doesn't really hinder you as much, because if it was just updated, then the depreciation cycle hasn't started.
Okay.
And so you're not going to get killed on it. But if you have a 30-year kitchen or a 40-year kitchen, you're probably going to get 30 cents on the dollar to replace it.
Got it. Okay.
So, and as you can see from a beginning investor who they're buying their first one, they're usually not flush with cash. Usually they've put together the nest egg to buy that first property, and it's not like they got 30 or 40 grand set aside in reserves yet to compensate for that loss.
Okay.
So I always advise on the first 1 or 2 to go replacement costs, and then as you build a portfolio and you build up those reserves, then if you want to take a little bit more risk to save on premium, then you can do so.
Okay. Jason, so what's is there a difference in cost savings for the investor if they go with actual cash value versus replacement costs, or how should people be thinking about that?
Sure. I think the easiest way to think about it is if you're buying a single family home, and let's say the single family home is $50,000, but it's 1,000 square feet. So
okay.
$50 per square foot is the market value.
Okay.
Many insurance companies will want to, in order to extend the replacement cost coverage, will require you to insure the building to 100 grand or $100 a square foot.
Okay, just because that $100 is an arbitrary number, that's a number they come up with?
They feel like that's they're getting enough rate or premium in order to extend replacement cost.
Okay.
So, versus, so let's say on an annualized basis, the replacement cost policy at 100 grand is $1,000.
Yeah.
Versus the ACV policy insuring it at 50,000 is $500. So they just work their rates of, their actuaries are back in the, in the back room making as much
punching numbers away.
That's exactly it. And they just say, no, we need this rate in order to extend the replacement cost.
Okay. All right.
So does that make sense?
It does. And so about thinking about BRRRR investors or value add investors, if I'm someone that goes and buys properties for 50 grand, knowing that they're going to be worth 100 grand after I put, 20 grand into them, what type of policy should I be looking for if that's my strategy?
Sure. Yeah, there's a couple different ways to do it. So one, the insurance company always wants to kind of insure exactly what you're buying. So if you're buying something for 50 grand, and it could be worth 200 grand, they're not going to want to insure that to 200 grand right away. Okay. So we do have many investors that will buy that thing for 50 and they'll just say, hey, you know what? We just got a kitchen done. It's another 30 grand, bump it up to 80. And you can tier it up, throughout the year. Obviously that's kind of a pain in the butt. So you want to try to maybe, do it in bigger chunks or if you're just in this market can get contractors really fast, just bust it out in a short period of time. Right.
Yeah.
But that's probably about the easiest way to do it, is just to kind of inch it up as you go. But here's the thing is everybody wants to insure for the ARB value, after replacement cost or after repair value. Mm-hmm. But the insurance company is only going to pay out what you've invested in it. So, and they're not going to give you the market value. So if you buy the property for 50 and you've put 30 in and you're like, hey man, now it's worth 120. That's great. But if as soon as you get that, you made the improvements and you have a claim, the only amount that the insurance carrier is going to give you is that 80 grand.
Really?
Yeah.
Even on a replacement cost policy, or now we're still talking ACV?
No, if you go to rebuild it, you'll have the policy limit. But if you decide to not rebuild it and just cash out, you're only getting the money that you put in.
So even on a replacement cost.
Yep.
Okay.
Yep. And if enough time's gone by, meaning like 6 months to a year, then they'll bring in a third-party adjuster and or appraiser, I should say, and kind of give you and then at that point they'll say, oh yeah, it's worth 120. So,
okay.
Right. And so, but if you literally just finished it and they're like, hey man, 6 weeks ago you bought for 50 grand and you just put 30 in, you're telling me we're not paying you for we're not paying you for the extra. Now, to speed that up and say, okay, well, I'm going to flip this thing really fast and I already have an offer. Well, as soon as you have that offer on paper that somebody says I'm going to buy it for 120, then they'll give you the 120 for it. But there's that window of time that, that everybody says, oh, I just made this money, but it needs to season for a little bit for the insurance carrier to pay that out. And that's kind of a little bit of a gray area. So I've never seen it where people really, I've seen it online where people said, I took the loss right after and I'm not getting, the true market value of what this was worth.
Yeah.
But it's never happened to one of my clients. But it's a risk.
Well, when you got Jason in your corner, I mean, no way it's going to happen. That's really interesting. That's really interesting. Okay. So it's that seasoning period that you've got to own the property. Okay. That's really good to know.
Really so as long as you get somebody to write offers ASAP,
you're in good shape.
And again, in this market, it still works, right? So you probably can dodge that bullet.
Okay, awesome.
But that's the case.
And Jason, talk to me. I mean, you're talking about the value add investor calling their insurance agent, telling them, hey, I just put another 30 grand into this. And so what it sounds like I'm hearing from you is that insurance is not a once a year type of thing, set it and forget it. Right? If you're someone that's constantly adding value or making changes to property, there really needs to be a conversation with your insurance representative, not just a, hey, let's talk at renewal time.
Yeah. And I think especially for people who are buying, they're buying their first, the BRR method, and then they move to their second, people start to misunderstand that that's a major insurance change that you need to talk to your agent about. So as soon as you move your primary residence from your home, from address 1 to address 2, a lot of times people forget that the first location is no longer homeowner's policy, which is meant to be owner occupied.
Okay.
But it's now a rental or a vacant building, or it's being rehabbed, whatever the case may be. At that point, if people just leave a regular homeowner's policy on there and it's been greater than 60 days and you no longer are living there, you could have a declination of a claim because they're going to say, hey, you stated that you lived there full time and now you don't. We're not covering any of these claims. So that is another shift. So yeah, as you build the portfolio and move from one to the other, you got to make sure that you have those proper coverages in place. Now,
it makes total sense.
Yeah, I can jump ahead a little bit, but when you're doing 1 or 2 and you're working with your home and auto, agent or whatever the case may be, you really have to be on top of it. Once you get to 3 or 5 or more, there are commercial policies that are built for that, are built for real estate investors that kind of take that into consideration. Okay. But when you're dealing with, a State Farm, an Allstate, or anybody like that, anybody that you have a home and auto with, they're not going to make that change. They're not going to have the correct policy fit for you for that.
Okay.
So,
and that leads me kind of to my next question. So I think so many investors who are just getting started, maybe they own their home or they're renting and then they have a car. And so they've got their auto policy and renter's policy or homeowner's policy with the State Farm, with the Allstate, with the Farmers. And so that's the insurance, that's kind of their known insurance world. As they start investing, that's the first person they're going to reach out to is, hey, this is my insurance agent. So do those types of companies have great policies for investors, or should investors be looking elsewhere?
So they can have great options, and I'd say especially on the first 1 or 2, if you're in a very good financial situation where you have good credit, those insurance companies, their premiums are based on your credit. Okay. So you can have the exact same house, with somebody with 800 credit and they're getting $500 a year, and somebody who's got 550 credit, they might be paying double or triple that amount. Okay. For that same property. So from that stance, the first individual is probably best to stay with their home and auto carrier for that policy. That second person, they may want to spin off and try to see if they can get a lower rate on a commercial policy. Okay. So it's to each their own of what's going to be the best fit. But I would say that you can get some of your best rates on your first or second rental through your home and auto carrier. There's no doubt about it. Okay. Yeah, especially if you've been with them for a long, long time. So
good to know.
Yeah.
Good to know. And when you say commercial policy, what is that?
Sure. Say the home and auto policy, like that you have with the State Farm. Let's just keep using them as an example. The largest insurer of home and auto. So those policy forms, or the legal contract that it sits on, is a personal form. It's meant for a personal dwelling. Okay. A commercial form is more of a policy meant for a landlord. So it's meant for business, right? Okay. So it can be a rehab policy, a vacant building policy. It could be a non-owner occupied property. It could be leased, triple net. Any of those scenarios are all going to be on a commercial form policy, and it basically just removes the personal liability out of the policy. So let's say you have your personal home and you go play baseball over the weekend at some field and you hit somebody. Your personal home and auto, or your home policy, will respond from a liability standpoint for your personal liability in that situation. Okay. A commercial policy will not. It does not extend the liability off the premises. So when you're talking about a landlord, no big deal. Like, you just want to be covered for that property, on that property, and you're good to go. Obviously, but when you have a home, you want to, no matter what your shenanigans are over the weekend, you want to make sure that's covered. Right.
Okay.
Yeah. Hopefully that makes sense. That's kind of the main difference.
That makes total sense. All right, Jason, let's shift gears here just for a minute and talk about people who are house hacking. So people who are kind of their landlord, but it's also their primary residence. Sure. What type of policy should they be getting?
So if it's still their primary home, they will want to be getting a homeowner's policy. Okay. And within that policy, and if the insurance agent sees that it's a duplex, they should automatically know to go ahead and add the landlord liability onto that policy. It should be built into their rating system, but it's really a little bit of both. Even if you have, two properties or two buildings on the same property or same parcel, you're living in the front, you have a garage rental in the back, whatever the case may be.
Yeah.
As long as it's still on the same legal parcel of land, that needs to be a homeowner's policy.
Okay.
And then they just add landlord liability to cover that back unit.
Okay.
So that's first. Now let's say you move from that property and you buy a nice one down the block. Now that first property becomes a full-blown commercial landlord policy, and you buy a homeowner's policy for the new building.
Perfect.
And that's just kind of how it keeps going.
Okay. Perfect.
As soon as you get to 4 or 5 single families, or rentals, at that point, I advise it's just usually easier to then silo both your home and auto coverage and then your landlord portfolio. So it's okay to have it blended for a little bit, but at some point you start to run into a risk, or not risk, but complications where the insurance company, and these numbers always change, but there's other companies similar to Allstate, Nationwide, State Farm, where they may say, hey, we're only going to allow you to have 2 rentals.
Okay.
And then you got to go commercial. Well, their commercial policy is like 4 times the price of the home and auto policy that they, that you could get paired up with your home and auto. So you're going to want to get that, you're just going to run into a roadblock. And at that point, you're going to go out and look for another standalone, commercial policy. And at that point, it might just be best to move them all to a new program. And that's usually kind of when people usually start to run into myself.
Okay.
That's usually, I'm fixing a lot of problems of people that have anywhere from, 3 to 15, properties or units, and they're still working with their personal home and auto carrier, and they just they can't do it anymore.
They can't handle it.
At least can't do it on a reasonable basis. Those policies are sometimes no good for the commercial lending that you then start to have to do after, you get, 11 loans or something like that.
Right.
So, it's a little bit farther down the road from a 1 to 5 space that we're talking about, but it's kind of like right on the horizon if you're going to keep growing.
Okay.
So,
and kind of continuing down that chain of thought, how should people be having these conversations with agents, brokers? What type of questions should they be asking, and how should they be kind of interviewing and screening folks as they're looking to make that transition?
And that is one of the toughest parts, is like, how do you find the right agent? And there's really
how do
no
you find the Jason
secret
Bott of the world?
Right. Because it's kind of like saying, I don't want to call us used sales, car sales guys, but it's like, you're asking a car salesperson, like, hey, who's the best car salesperson to buy a car from? But the way that you want to look at it is any of the people that you see a lot of the commercials on, the State Farms, Allstates, they represent the one product.
Okay.
And it can be good, but it's still just one product. And then when you get multiple quotes from the other companies that are just, are direct writers like Allstate, Nationwide, they're still only going to have that one product. So when you start to call around to an independent insurance broker, now they will either be an independent personal lines agent or most likely independent commercial. There's not that many that do both.
Okay.
At least I would say that the people that are really niching out and doing well in this space. So versus like myself, I represent about 50 different insurance carriers. So when you come to me, I'll be able to almost fix any of those problems that you might be running into. Like you can't get the LLC added onto the policy. They'll say, well, no, we don't. Well, we want to insure it on your personal name and then add the LLC as an additional, interest on the policy. It's like, well, that's not really the correct way to do it. But a lot of those other companies, they'll do it just to write the policy. So in that case, the agent's kind of solving your problem, but they just don't want to lose the business. They probably know that it should be set up slightly different.
Okay.
So I would say just realize that who are selling just the single solution.
Okay.
And it's still an option, but you also want to get the second opinion from the independent brokers as well.
Okay. And are all independent brokers created equal?
No, that is another thing that's kind of hard. Everybody will say, hey, we just shopped all the options. Well, that agent might only have access to 3 companies. So it's like, well, it's not all the options, but it's all the options they have access to. So the way it works in our industry, the way the distribution's set up is in order to get a contract with a specific company, you have to commit to a certain amount of volume. So that's why some of the larger brokers like myself will have more contracts. And so we'll have more options for you. But it takes years and years and years. And if you don't produce enough volume, they will drop your contract. Okay. So and then the other part of it is, that makes it difficult for investors just starting off is most people that are in my position don't work on accounts less than 10 grand in premium. So they're going to ignore the call for the 1 rental, 2 rental, 3 rental. They're just not. And so when people are calling around saying, hey, no one's returning my calls, that's why. They just don't want to, screw around with it. So I just made a commitment to the space, and I know that if somebody's buying one, that's usually not their end goal. It's just one, right? They usually want to get to some sort of financial freedom. So whether that's 10 or 20 or 50 or 100, whatever the case may be, I know if we can save all their problems up in the, save or solve their problems on the front end, that we'll grow together and we'll be able to get them set up correctly, as they grow.
I love that.
That makes sense.
You're willing to help people get there. You don't just want them once they've arrived. Yeah.
I want to say that you have all sorts of problems going from 1 to 10 locations. There's a lot of growing pains. There's a lot of restructuring. Again, you start to get the lending changes and everything else, and you start the LLC stuff. And if somebody comes to me with 50 locations, that's almost easier to do than if somebody has 15 and they want me to restructure it.
Really?
Because it's just straight. They've already cleaned up it's all commercial lending. We have it on a big schedule. We just market the schedule. It's good to go. Versus, we're reworking one right now. I have a client that started with me about 4 years ago, just one at a time. And they have about 25. And he has them, I think he's got 5 different companies, and it's just, he's been in all sorts of different states. So he's in Indiana, Wisconsin, Ohio. And so that we just kind of plugged and played them in the best spot. And now we're just restructuring them all onto a single date, one policy. And I mean, he's saving a little bit of money, but in this market, it's about apples for apples.
Okay.
A couple of years ago, if you consolidated everything, you were saving everybody about 20%. And that was really easy to, there's no selling involved there.
Right.
Just 20% less, right?
And Jason, I want to know, because it's a question I get all the time. There's 3 different values that people see and get really up in arms when they're not the same. And that's purchase price, whatever they paid for it. That's insured value. And that's often taxable value at the county level. So can you talk to us? I mean, what is the insured value? If I'm insuring this property for 200 grand and I bought it for 100 grand, I mean, why is there such a disconnect there?
Sure. Well, if the first part goes back to the beginning of our conversation about where the insurance carriers need to have a certain amount to get the replacement cost. Right. Let's call that $100 per square foot, right? But the other part is, what's it going to cost in total to replace the whole entire policy, or the building, I should say.
Okay.
Right. And unfortunately, with what happened last year in 2020, with the escalating, construction costs and material costs, that number has grown by like 30%. So right now we're seeing in 2021 we're seeing that, last year the insurable building was 200 grand. And now they're saying, we really need 230 this year. And people are like, well, I still only bought it for 100.
Right.
But the problem is lumber's gone up. You can't find a contractor to get the work done. When you do have and keep in mind, we're rebuilding the building. So if you have a kitchen fire, and I know you've had a claim and you've gone through a claim personally, so you know how long this stuff can take.
Very close to home.
Right? The shortage of contractors, it extends the project, which then obviously escalates the cost.
Right.
So that's just all a byproduct, and that's what's driving up the insurable building value. So a kitchen fire that used to be able to be knocked out in 4 months is now taking 7 months, 8 months, and that holding cost there for the loss of rents, payments, and so forth, that's just going up. And so that's why that insurable and building limit is just getting kind of higher and higher. It's for labor costs and building costs. I believe that with the way that inflation is going and everything, and if it slows down the market a little bit, I think that will level everything off a little bit for a year or two.
Okay.
But we're still seeing, on all of our renewals from last year, we're still seeing 15%, 20%, increases on what the insurance carriers want to insure to.
Wow. Okay.
And we can push back, and if you have a big enough portfolio, and you're able to push back and just say, well, I'm willing to take a little bit of a risk. So instead of 100% of the claim being paid, maybe 95% of it gets paid, and I'm going to keep the building values the same. I mean, that's another strategy to kind of keep your cost in line.
Okay. So, Jason, is it fair to say then that when you get a quote from an insurance company or a broker that it is, take it or leave it, it is what it is, or it sounds like you're saying that you might have some negotiating room there?
Sure. I would say that on the personal line side, there's very little negotiating power. Or flexibility, I should say. Usually those agents, they're punching the information into the system, and the insurance company is just saying, hey, this is what you need to insure to, period.
Okay.
On the commercial side, we do have a little bit more flexibility, and you can push back on those values, and maybe you're able to, instead of insuring it for, a property, like say for 200 grand, and now it's 230, and we say, no, we want to keep it at 200,000. The insurance company might say, well, that's fine, but you're now insured to about 90% of where it should be. So if there is a claim, you might only get 90 cents on the dollar. And for some investors, they're okay with that. So, but personal lines is difficult. Commercial, you do have more flexibility. So if that's, if you're in a lower end market, then that's probably where the commercial might be a better fit for you because of that.
Yep. Okay. That makes total sense.
Yeah.
Jason, let's transition now to talking about like actual coverages, because I love for the show to be actionable and we have, give people things to go then do. So as an investor, what coverages should people expect to see standard? And then maybe what coverages do people need to ask for and should consider thinking about?
Sure. So the three that are almost non-negotiable that you want to have on every single policy is your property coverage. So just be the building coverage.
Okay.
Your general liability.
Okay.
Or premises liability, be named several different things. And your loss of rents.
Okay.
Or business income, depending on which kind of policy you have. So the building covers, obviously, the building in case of the fire. The general liability covers in case there's a slip and fall. And I don't really recommend, again, on a personal policy, your max might be $500,000. But it's usually to go to $1 million, it might be another $8 per year. So we just write $1 million straight across the board, and we never really go any lower than that.
Okay.
And then the last part is business income or loss of rents, and that's if in case you do have a fire and you have the property leased out, then you go ahead and they will cover the loss of rents up to a year while that property is being repaired.
Okay.
So
now,
those are the three that you really shouldn't waver on at all, and they should be on every single policy.
Okay.
So.
And to your point previously about the kitchen fire that used to take 4 months to repair is now taking 7 months, 8 months. On the loss of rent stuff, is there the ability to get coverage beyond a year? If, in the case like we had those California fires and neighborhoods just got decimated off the face of the planet, those homes aren't getting rebuilt inside of a year. So is there some additional coverage that you can get if you're concerned with that type of event? It's
not common on a personal policy. They'll usually cap it at 12 months. Same with most small commercial policies. But if you could there are some portfolio policies out there. And again, a portfolio might be 3 on a policy or 5 on a policy or 10. Those are usually the minimums for most of the programs. They can go up to 18 months or 24 months.
Okay.
It's funny. Most people just say, I just need 6 months. We can get knocked out in 6 months.
Right.
Then you have those natural disasters, like even when people don't realize it, but if there's a big natural disaster, like down in Florida or any of the coasts, all those surrounding states, like all the contractors, they take off because they're making 3 times as much down the storm areas because it's all insurance work.
Right.
And then there's nobody to, and then you're back up, 500 miles from the coast and you have a kitchen fire and there's nobody to fix it.
Right.
And now that thing's taken more than a year. So, you don't want to go too far down the rabbit hole, but that does happen. So I recommend 12 months of loss of rents, for sure. Especially again, in your first 1 to 5 locations, 12 months minimum. That's what I'd suggest. So,
okay. Love it.
So some of the other ones that are kind of always on the fence, and the one that we get probably most questions on is the backup of sewer and water. Okay. Because that's on your homeowner's policy and it's usually not on a rental policy. You usually have to ask to get it endorsed onto your policy. So, and that is just any sort of backup sewer. It can happen in the kitchen, it can happen in the bathroom, it can happen in the basement. There'll usually be a $5,000 or $10,000 limit on there. and it usually costs you about 50 or $100 per year. And I
Okay.
say it's really up to the individual investor if they think it makes sense. The problem with those claims is if you file it once, usually they're going to remove it off your policy the following year. I'm specifically talking personal home and auto policies.
Yeah.
Right. They will. So you get one shot at it, and then they're gonna penalize you for filing the claim. So
Okay.
all my other landlords, anybody that's got more than 5 locations, we just do not carry that coverage on there. They'll just send their crew over. They'll pay out of pocket and go, hey, if I have 20 locations, I'm saving $2,000 a year. Well, I can send Joe over there for $750. We get it cleaned up, and I'm ahead for the year.
Yeah.
That's usually how investors just try to teach how they kind of grow out of that coverage, if you would, right?
Okay.
The next one, which is really important and it's probably the most overlooked one, is building law and ordinance. And you have older buildings, so you're familiar with some of that.
Yes.
But let's just say you have a 1900 building, or a building that was built in 1900, and the front door is 29 inches wide, or some odd. You go ahead and you have a kitchen fire, and then the fire department comes over and they put it out. They bust out some walls, and then now the building inspector for the city comes over and says, "Well, that's great. We can do this, but in order to grant occupancy permit here, we got to bring the rest of your building up to code." Okay. So in the insurance world, the fire damage is covered, but anything that you're voluntarily destroying and upgrading, that's not an insurance claim unless you have building law and ordinance. Okay. So that's what picks that up. So if you have a building, usually 1970 and above or and younger, usually it's not that common that you're going to need it.
Okay.
But for older buildings, especially older parts of the country, and if you have a rental that's really wonky and it's got all these goofy, like the fuse boxes inside the bathroom, or we've had egress doors needing to be put in place of closets. I had an 8-unit one time where all the meters were in the basement and they needed to be moved outside of the building. That was $35,000 for the electrical, for the gas company to do that. And that was a building law and ordinance claim,
Wow.
So you just kind of got to keep your eyes open. And if you're like, boy, this just doesn't seem right. I think most people will feel like, you walk into the house and then you walk down 2 stairs and then you walk up 4 stairs. Like, you're probably going to want to get building law and ordinance coverage there.
Totally. So. I mean, it's interesting. You talk about kind of that 1970s vintage. I've got my very first property was 2004 build, and it's something that I carry on that property too. Because in California, all residential properties, I think it's post 2008, have to have fire protection sprinklers.
Yeah.
So if the house burns down and it has to get rebuilt, there's an extra cost there that I need to incur, even for a newer property like that. So
that's very common once you get into the multifamilies. And so I just tell people, hey, call the city, see what their guidelines are. Because if you have a 16 unit or something large and you need to retrofit that thing with a sprinkler system, it could be $200,000, to do that. So
yes.
That's why I say just kind of take a look around and see if it's wonky and just get it thrown on there just in case. But that's another one that could cost you a lot of money. So
okay.
And then, lastly, we talked about it at the beginning, but I would say the other thing is most people just keep their liability limits so low, because some personal lines companies can go to $50,000 or $100,000 for their liability limits. And, that's for anybody that's slipping and falling on your property. Okay. So if you don't have, the right window or whatever, and the kid falls out of the window, even if it's on the first story and he breaks his arm and now he needs rehab for, a year or two and he has some sort of permanent disability, that's going to go beyond $100,000. It could go beyond $300,000, and that's a very possible. I had a $25,000 claim because it was an overweight woman who's too heavy on the front porch, and she crushed the porch, and then they couldn't, she couldn't get herself out, so they had to call the ambulance, and that was like a $25,000 liability claim because they claimed the porch wasn't up to par, but she was, she was a very large woman, and so
oh my gosh,
and I've had people. I had a $50,000 claim of a hole in the front yard that probably one of the tenant's kids just dug, and then somebody went through and blew out their knee, and that was a claim. And again, those are very that stuff happens all the time. Falling down the stairs. Well, you didn't secure the carpet good enough. and I want you to pay for all my knee damage. I mean, is it that common? No, but I mean, we have several of those per year, in the house here. So we rarely, everybody gets all excited about having an umbrella policy, so you have your general liability goes to $1 million, and then you can buy another $1 million. I've never had a claim go over $1 million on a single family home. So I always say $1 million is probably adequate.
Okay.
But all these other little nuisance claims, can get over that $100,000 or $300,000 mark. So
okay, perfect. And you touched on it, and it's the last question that I'm going to ask you, Jason, before I let you out of here. How should people be thinking about liability limits? And I know you just touched on it, but is there kind of a good guidance or rule, ballpark to think about how much coverage someone needs?
Sure. Well, I think the part that I didn't address was, let's say you are doing a house hack and it's a triplex. Okay. And sometimes I've even seen people pull off a fourplex as their first property.
Okay.
Well, I would say, I don't know if you believe me, but I've seen it happen. People have done it.
That's very impressive.
Right. And in those cases, now, even if you're living there, obviously now you have 3 tenants. Right. And now you can have all those different parties, suing you. Right. So that's the first part, is how many people can sue you.
Okay.
The second part is, for those people, if they're injured or whatever the case may be, there's a loss of income factor that when a lawyer sues you is like, hey, how much income could have this person made, and that you caused their injury. So if you have, working class people that are making $30,000, $40,000, $50,000 a year, that number doesn't get up that high. But, if you have, or if you're in a metropolitan area where like you're in California, or if you're in New York and you happen to be renting there, people make much more. They're making $100,000, and so if you have 3 people making $100,000 that sue you, $300,000 is not gonna, you're probably gonna be underwater somehow, with that. So that's another factor, is what kind of clientele you have. The third is just in the state that you're in. Is it landlord friendly or is it tenant friendly? Because if it's tenant friendly, then you probably want to go higher.
Okay.
There's some southern states that they're very landlord friendly. So the liability limits are really, really low. But, you get into certain, Chicago, Miami, New York. I mean, anything happens and people they're suing and they're hitting $1 million mark pretty easy. So that's the other thing, is what municipality are you in?
Okay.
And, which way are they leaning?
Okay.
Yeah, that one. And then I think the other thing too is just, are you the one maintaining the property? Are you the one renting it out? Now, obviously, if you're in your first one, your second one, chances that you are. But I also work with a lot of out-of-state investors. They're in California and they're buying, in Tennessee and in Ohio, and I know that's part of your clientele as well. In that case, I'd say if you're depending on your property manager to do all that stuff, they may be telling you they're doing it all. Oh yeah, I shoveled and yeah, that's good to go, and yeah, that's fixed. But you don't know for sure. So I always say I would always err on the higher limits if you're not the one actually taking care of the policy, and you're not the one that's got the finger on the pulse of the building.
Okay, but if I have a professional property manager, is there some risk reduction that now there's kind of a buffer with a property manager in between myself and the property? You
can, but the way the claims work in the insurance world is one, the property manager always asks to be added to your policy.
Right.
So that any claim on the policy gets filed through your policy. Right.
Okay.
So your policy is going to pay, so now there's a claim on the property and the tenant sues you and your policy is going to pay and you have $300,000 limits. They're going to bring in possibly bring in the other party, but the contract states that no, it's only on your policy. So now you go beyond your $300,000 payment that's on you personally, and now you got to go after the property manager for the difference. Well, that whole process is like a 5 to 7 year process, right? So you just don't want to have to ever go into your own pocket. I mean, the whole purpose of buying real estate is to make more money,
right?
Not to be paying out all these things. So that's why I just say I just go with $1 million on a single family, and it just solves most of the issues I just reviewed. I mean, they're kind of just all taken care of. Okay. But sometimes people are like, "Hey, I'm going to save that $15," and it's like, man, That was a
Worst-
loss of $15.
Right, worst $15 decision you ever made.
And but they're all super excited about the water sewer backup, and I say just take that money and put it towards the liability. You may have a wet basement for a little bit, but
right,
that's the way I would look at it.
Okay. Jason, this has been awesome, man. Thank you so much for taking the time. There's still so much more that I want to talk to you about. I'm sure we'll have you back. But for those people that want to get in touch with you, that have additional questions or want to reach out to you for insurance needs, what's the best way for them to do that?
Sure. You can give me a call at 414-270-6834. That's my main office line. Or you can drop me an email at jbott, that's JBOTT at Robertson Ryan. And that's ROBERTSONRYAN.com. And I currently have 4 team members. I mean, Michael, you're familiar with most of them. All they do is work with my real estate investors. So we try to continually stay overstaffed so that we can respond to people fast and get people through closings, because that's always it's always an issue. Always an issue. So I appreciate the time though, Michael.
Absolutely, Jason. We'll be chatting soon, I'm sure.
Sounds great.
Alrighty, everyone. That was our episode. A big thank you to Jason. We look forward to having him back on to talk about all of the other things insurance related. I know I get really giddy about it. Hopefully you do too. If you enjoyed the episode, please feel free to leave us a rating or review wherever it is listening to your podcast. And as always, we look forward to seeing you in the next one. Happy investing.